Now back to our conversation with Fitch Solutions. We're having John Kapati, Senior Analyst, Country Risk, Sub-Saharan Africa, to talk about the macroeconomic themes and the outlook for Sub-Saharan Africa. Good afternoon, John Marco. It's good to have you on the program.
Hello, thanks for having me.
And so we've seen, and one of the key themes for Sub-Saharan Africa that you mentioned for countries, you say you see a moderate pickup in economic momentum, which of these economies, which of these countries are expected to drive this growth?
So we see a very moderate uptick in regional growth from 3.4% last year to 3.6% this year. But the largest four markets will actually see growth weakening. And we continue to flag high downside risks, including for South Africa, where the central bank just recently revised down its own projection for this year's growth to just 0.3%. Also, our main point is that regional growth will remain well below the average of 4.1% between 2010 and 2019. And for a group of mostly frontier or emerging markets, that's not the growth rate you want to end up with, as it's probably barely above population growth. Now, there are some good stories. We think East Africa will be the main engine of regional growth this year, and especially Tanzania, where we expect strong investment-led growth, and Ethiopia as well, where we see the economy recovering from a two-year conflict in the north that just ended with a recently signed peace deal. And then West Africa, despite weak performance by Nigeria and Ghana, we see strong growth in economies like Cote d'Ivoire and Senegal. And here again, lots of investment into the gas sector for Senegal and strong public investment in infrastructure projects in Cote d'Ivoire, as well as very low inflation there by regional and global standards.
And so what are the major concerns for the countries expected to underperform this year?
So each of these economies has its own domestic challenges, but there are some common themes. In South Africa, for example, the main drag on growth at the moment is worsening power cuts, and this is just crippling activities, forcing firms to delay much needed investment that could help reverse the decline of the economy. And on a political level, this just fuels discontent at a time when we're seeing lots of strike action over rising living costs, and it will threaten the performance of the ruling party at the general election next year. We think it's going to really struggle to obtain a majority for the first time in history. In Ghana, we've seen weakening investor confidence, driving a sell-off of the currency, pushing up inflation to about 50% in November, and the ongoing debt restructuring process by the government will cap sentiment in the near term. And again, with implications for unrest and the 2024 elections, where we expect the current governing party to lose. Similar inflation dynamics in Nigeria, and here we think this will compound the impact of falling oil production and moderating oil prices. So we forecast growth to continue to slow to just about 2.5% this year. And again, next month's election is probably going to be very closely fought and potentially highly contested. It's a tricky time for these economies. And in Nigeria and Angola, falling oil production really underscores the importance of diversification and good management of natural resources, which hasn't really been the case, especially in Nigeria.
So you talked about Ghana's currency being impacted. How would other currencies in the region be impacted by this underperformance or the outlook you've just projected?
So the factors that are weighing on growth in some of these markets are also affecting the currency outlook. So in short, our view is that the US dollar has peaked and will weaken a bit this year, but not every currency in SSA will be able to benefit from this. So on the one hand, we have currencies where we expect strong performance, such as the West and Central African CFA francs, which are pegged to the euro and will likely appreciate a bit over the course of the year. The South African rand, the Kenyan shilling, and the Ghanaian cedi itself will remain on varying degrees of depreciation, but more moderate compared to last year, as they're helped by the weakening dollar and a slightly better appetite for emerging market assets this year. Now, for some currencies, we actually expect a worsening outlook. So once again, falling oil prices and domestic oil production will take a toll on export receipts in Nigeria and Angola. So obviously their currencies, the Naira and the Kwanza. And despite an improving security situation in Ethiopia, the country is a big wheat and fuel importer. So the rally in prices last year has really depressed foreign exchange reserves. And we think this will prompt the central bank to increase the pace of devaluation of the Ethiopian birr this year.
So you're looking at this bleak projection you just given now. You do expect Fitch Solutions still expect the monetary policy tightening to slow in Sub-Saharan Africa in the second half of this year. This is despite high inflation levels and fiscal policy dilemmas that the countries are facing. How would that work?
So we think monetary tightening will slow despite still elevated inflation, which we forecast will ease from around 18% last year to about 14% in 2023, so still above the past 10-year average of about 10%. And reflecting this, we expect some more tightening, especially early in the year, in countries such as Nigeria and Ghana and South Africa. It happened last week, before central banks begin to then hold policy rates in line with the US Fed, or in Angola even cut them because they have space and inflation has been slow in there. As for our fiscal policy theme, we think rising government spending on debt servicing will reduce fiscal space and create policy dilemmas for governments. Now, because we think policy rates in developed markets won't be cut until 2024, and some risk aversion will persist due to recession fears, we think bond yields in SSA will remain elevated this year. So still tight external financing conditions, and this will force many governments to continue relying on domestic debt, which usually comes with higher interest costs in SSA. So despite pressure to keep anti-inflationary measures and subsidies in place, governments will have to make tough policy decisions to find room for that, especially as interest rates remain high domestically. So other policy measures that could make up for that are hiking taxes or cuts in other areas of spending. So we think more countries are likely to resort to IMF lending, like in 2022. And actually a new program was approved just last week for Mauritania.
Okay. Thank you so much, Gianmarco Capati, Senior Analyst, Country Risk Sub-Saharan Africa, Fitch Solutions, for joining us on the program today.
Thank you.